Hello everyone, welcome to chapter 10 and 11. These are the last two chapters for level 2 of CPI, right? And with these two chapters, we'll sum up everything about the price aspects of charts. And with the end of these chapters, we'll have laid out the full fundamentals and basic aspects of price, right? Now, chapter 10 is going to be about ranges, what ranges are, what are its types, and how to actually trade it, right? Now, for some of you, you might already be familiar with the content in this chapter, and the chapter might seem and appear a bit cliche. But my objective and goal with these two chapters is to finally lay down everything about ranges and turtle soup, right? And how they work, and then when we've discussed these two chapters, we can successfully move on to level 3, where our sole and main focus is going to be on time and the time aspects of charts. Now the time aspects of chart itself will also take at least 2 levels of CPI, but I assure you that this is going to be the best content you will ever see and you will ever see on time and price and how to integrate both of them together, right? And obviously we'll have trade breakdowns where you'll see how to actually use it in live markets and you'll see the live application of it. So first of all, again as usual, we're going to start off with introducing and defining ranges, and I'll give you the most refined and as relatable definition I could have came up with for ranges in general, right? So basically, when price moves within a fixed range or a fixed scale of price, particularly between a high and a low for over a period of time, that sort of market condition or that price condition is known to be a range or range bounded price condition. That is what we call a range, right? Now right here, for some of you, you might have already heard or learned about it already, and this might already sound familiar with you, but you still have to make sure to watch this whole chapter, because not only it will refine and refresh your fundamental understanding about ranges, but it will also fill some voids or confusions you might have had about it, right? And if you already knew everything about it, then still these two chapters will refresh your thoughts, right? And it's important for me to discuss all of it and not leave anything out just because someone in the group already knows it, right? First of all, even those that know about it, their thoughts would be refreshed and refined when watching these chapters, right? And then those that literally aren't aware of it, they'll get to build their understanding of the markets and price even more, right? So make sure to watch these chapters even if they sound cliche and you might have already heard or learned about it, right? It's important for you to revise these chapters, right? To refresh your thoughts and to refresh your understanding about the markets. You might have taken it for granted, but you don't know that the most important aspects of trading are your basic and fundamental understanding. If they're not built correctly, then you wouldn't be able to move on to the advanced level, because they're all derived and dependent on the basic concept, right? So it's important for you to revise them. So, when price moves within a fixed scale of price between a high and a low over a prolonged period of time to generate liquidity, that particular price is said to be in a range or ranging condition, right? Now, the second most important thing about ranges are to stay away from the inside of the ranges and only trade and approach the extremities and the extremes on the ranges only when they're purged, and they're purged at a key time, right? If the buy side liquidity of the range has purged, you sell there. And if the sell side liquidity or range low is purged, your objective is to buy. Again, a bit cliche, but definitely worth it and a necessary part of your understanding, right? You want to repeat these things to yourself and your thoughts as much as you can, so that they almost become subconscious, and that you don't have to even think about it, right? In my trading, I have reached a point where I've repeated and replicated these things so much that they are literally on the back of my head. And I don't have to actively think about it. They become almost subconscious, where my mind is trained to see it. I don't have to force or actively use any mental energy, right? And that should be your aim as a trader as well, right? So don't be afraid of rewatching any chapters or revising a particular content or chapter, because you might think you're learning nothing more from it. But in reality, you're actually doing yourself a favor by repeating and revising them, because you're training your mind and your subconscious thoughts, right? So always remember this when you feel like you don't have to revise or repeat anything, right? This is the exact reason why I've watched the whole core content of ICT like almost 20 times. The first 5 to 6 times I watched it, I got new things out of it. But then the remaining times I watched it, I only watched it so that first of all I don't forget about it, and second, to revise and repeat these things so much that my mind is forced to remember it, right? It's forced to remember. You have to force your mind to remember these things, and almost make it subconscious, right? And that's exactly what I've done. So don't be afraid of rewatching or revising your basic or fundamental understanding, right? Because they are as important as your advanced understanding. Again, buy below the range low and sell above the range high, right? And trade only the extremes of the ranges and stay away from the inside. Now moving on, this is how a typical range looks, right? We've got a low and a high, and price is stuck between that low and high, which we also call a range low and range high, right? And price isn't able to make any significant move, and staying between that low and a high over a prolonged period of time, this is what we call a range. Again, we would stay away from this type of condition and only trade it when price breaks out of either of the extreme, right? And then we will use our respective entry models or entry setup accordingly. Now moving on, here we got the type of ranges, right? Now first one we've got is the typical ranges, which are a bit subjective, and I rarely ever use these type of ranges because first of all they're subjective and their highs and lows are not clearly defined, but it's necessary to be aware of its structure and dynamics, right? Typical ranges are basically range bounded price movement stuck between a high and a low, which I just showed you earlier, right? And knowing about typical ranges will help you understand the rest of the types and the rest of the examples even better, right? Now we don't use typical ranges that much, right? And pretty rarely they are ever needed, but the rest of the ranges are derived from its fundamental dynamics, so it's best to learn about it as well, right? And next one we've got is CRT ranges. Now we are aware of these type of ranges as well, right? These are basically higher time frame specific candles that follow specific protocols that are used as ranges on the lower time frame. Now again, CRT ranges in itself require a whole chapter, and I'll be making a few on it, discussing its detail and intricacies. But here's a brief summary of it, right? So higher time frame candles that are used as ranges on the lower time frame are called CRT. CRT are dynamic and objective because they've got fixed objective highs and lows, including its opening and closing times, right? Because after all, they are basically a candle, right? So CRT ranges are one of the most high probability ranges. So then we've got the time ranges, which just as the name suggests are dynamic ranges derived from certain particular times of the day or times of the week, right? They're time dependent and they're objective because the extremes of such ranges are found within the time windows, right? I've just mentioned. Now, example of time ranges are the Asian session range, the central banks dealers range, and even the Monday candle CRT or range, right? All of these ranges are deemed as time ranges because they are formed at specific objective times, right? Now, let's look at some graphical representation of each type of ranges, right? So first one we've got is the typical range. We already saw this one before and it's pretty simple, right? We've got a high and a low and price is stuck between that high and low, and this is what a typical range looks like. It's a bit subjective compared to the other types. Next one we've got a CRT ranges, right? Now we all know how they look like. First one we've got is the three candle CRT right here. You can see first candle is the CRT range, then it's budget the second candle, and then this third candle distributes lower to take out the opposite of the ranges. And the second we've got the inside bar CRT. These type of CRT are more high probability CRT than the three candle CRT, but almost both of them work accurately, right? Now, one thing you need to always remember is that you must find all of these ranges in the direction of the higher time frame down liquidity, or simply you only trade it only when they are formed in the higher time frame down liquidity's direction, right? This is a must for trading such ranges. Now, again, choosing a CRT in itself is an art, and it has multiple protocols and intricacies which you must look for when choosing it, right? And we're going to discuss them all in later chapters. But basically, they are higher time frame candles which are traded on the lower time frame as ranges, right? Now, moving on, here we got an example of time ranges. You can see right here we've got some times here. First one we got is from 16 Eastern time to 20 Eastern time, and this time of the day represents the central bank's dealer range, right? And price usually ranges or form consolidation during this time of the day, and this time is treated as a dynamic range known as the CBDR, or the central bank dealers range, right? Then we've got another time range which is from 20 a.m. Eastern time, right? 20 Eastern time to midnight, and this is what we call the Asian session range. Now, defining the highs and lows for this sort of ranges are pretty simple. You choose the highest high and the lowest low from inside of this time window, and that would be your time range for that particular time, right? For example, in this example, we've formed this highest high and this lowest low during this particular time. So this whole range of price between this high and low is our Asian session time range, right? And we would be looking to trade it during the correct time of the day, and when it's extreme are purged correctly, right? Similarly, another example of time range would be the Monday candle range. If the Monday candle doesn't test a high time frame key level and it forms a range, so the high and low of the Monday candle would be treated as a CRT range in itself, and that would also be deemed as a time range because it's formed at a key time. Now, time ranges, just as the name suggests, are time dependent, right? And these are the most dynamic and objective ranges because their high and low and, and opening times are all objectively defined properly, right? Moving on to the next slide, here we'll discuss how to actually trade ranges properly, right? Now, we've already discussed some of these details before, but here I've organized all of these objective rules so that it's easier for you to journal and get familiar with, right? So here are the rules that you must remember when trading ranges. First of all, don't trade the inside of the range, right? It's an important rule, that's why I've mentioned it first, because you never know how long the range is going to go. So if you've ever tried to trade the inside of the range, then you won't have a correct on liquidity, and second of all, you won't have any objective protocols for putting your stops and targets, right? That's why never trade the inside of the ranges, and just simply stay away from price when it's inside of the range, and only trade it when it's broken through or it's purged, right? Second, we've got is that by the breakout of the low of the range, meaning when the low of the range is purged and partially broken through, you buy there. Obviously, you don't just buy there right away, but instead you wait for your correct entry model entry setup. But the predominant theory is that buy the range by the purge of the low of the range, right? And similarly for the opposite side, sell the breakout or the purge of the high of the range, right? Pretty simple. Next one we've got is an important protocol for targets. Now this one says that you must always target 50% of the equilibrium of the range, right? Whenever you get an entry, right, and you get a proper entry, you must always have the 50% of the range as your first target. And the reason for this being such an important protocol or rule is because 50% of the ranges or equilibrium of the range often tends to be good areas for price reversals or expansions, right? And oftentimes you'll see that when price usually that's where price usually reverses or expands from, right? So just to be safe, make sure to always partial and take out some profits whenever 50% of the range is crossed or reached. This protocol is used as a filter for taking partials and for staying safe at all times and lowering your risk. Now, another important rule is that wait for the purge of either side of the range at a key time, right? This is important because you want to avoid lower probability purges and only trade those that occur at key times, right? such as from 3 to 4 a.m. Eastern time, or from 8 to 9 a.m. Eastern time, and so on, right? These are the key times which you must look for the purchase, right? And last but not least, combine it with CRT. And what I mean by that is, when you're looking for the purge of the range to trade, then more often than not, you're gonna find is that there always a CRT at the top or the bottom of the purge, and you can trade that CRT in the lower time frame, and that will provide you with the highest probability entries, right? These sort of CRTs are always high probability and works best, right? So combine ranges with CRT. Even when it comes to CRT ranges, even with those sort of ranges, when they are purged, they are more often they not have smaller CRT above or below the purge, and you can then trade it on the lower time frames. Here we got a graphical representation for how to trade a range. You can see this is a typical range, and prices inside of it over a long period of time without showing any significant moves or purges. So during all of this time, your objective would be to just simply stay away from the charts and stop trading, right? You're gonna wait for either side of the range to be purged, right? And you're gonna wait for the side which is in the direction of the higher time frame down liquidity to be purged at a key time, and once it's purged, only then you will be allowed to trade it, and your initial target is going to be first of all the 50% of the range, right? Here we got in another graphical representation of trading a range, right? This is the most common way of how I trade ranges, right? This method of trading ranges is the most refined and objective one, right? And not only that, it's the least risky one, because first of all, not only you're waiting for the extreme of the range to be purged at a key time, but also you're looking for an objective CRT there at a key time, and such CRT always work out, right? Even if price eventually expands on you and your trade idea is invalidated, you still would have had made profits and gotten out, because you got a small range within the big range, which is our objective to trade, right? So once the range high spike, you will have a CRT there, and then you can trade this particular CRT on the lower time frame, and your target is obviously going to be the low or the high of the CRT. So you would be in and out of it pretty quickly, and you would just need small market movement on the higher time frame in your direction, and that's it, right? You don't need big swings. You can just trade that CRT on the lower time frame, and that would be it. Now it's pretty simple. Wait for the range to be purged at a key time, and once that's done, then not always, but oftentimes there's going to be a big candle which could be treated as CRT, and then you can trade that CRT on the lower time frame. If you reverse engineer my trades, then you'll find that most of my entries are based on this, right? I use it for continuation reversal entries too, not just range entries, right? And then again, we've got the time ranges, and you can see here we got the London Open closure from 2 to 5 a.m. Eastern time, and that is a key time for Asian range to be purged. And once it's purged, at that time, you're gonna wait for your entry model on the lower time frame and trade it in the direction of the higher time frame on liquidity. Now let's look at some examples right here. Here we got an example from last week. Now right here you can see these time, they are the CBDR range time and the Asian session range timing, right? Now right here you can see that this price action was formed during this particular time, this key time, right? So what we're gonna do is take the highest high and the lowest low formed during this particular time, and that would be our Asian session time range, right? And specifically our time range. Now obviously during this time, during the time it's being formed, you're gonna particularly stay away from it, but also you're gonna wait until it's purged at a key time, right? When it's not purged at a key time, you can still opt to trade it, but your probability would be comparatively lower, and you must always lower your risk for such type of trades. Or simply you can just opt to not trade such ranges at all. I usually stay away because I'm content with staying patient and just waiting for high probability trade ideas, right? So I wait for it to be purged at a key time, and once it's purged, you're gonna wait for your entry model or entry setup to trade it, right? Right here you can see that first of all it was purged during the London Open candle right here, and then it went to the other extreme and reached the target and purged it at another key time during the New York Open candle, and then it expanded above, right? Moving on, this is another example right here. You can see that we've got this CRT. This is the Monday's candle CRT. So not only it's a CRT range, but it's also a time range because it's formed at a key range time, right? So you're gonna wait for the high to be purged and then trade it on the lower time frame with your entry model and entry setup. And your target would initially be the 50% and then eventually the opposing of the range, right? Now let's get into chapter 11, which will be about turtle soup. What is turtle soup? What are its types? And most importantly, how to trade turtle soup and where you can find high probability turtle soups, right? We will discuss them all in this chapter. So right here, we're gonna start off with introduction, right? So turtle soup are basically and simply false breakout or purges of ranges or significant swing points, right? Which means that when swing points and ranges are purged or falsely broken through, those moves are called turtle soup. Now you could again call it whatever you want. You could call it turtle soup, liquidity range, false breakout purges, and so on, right? Now another definition would be false moves or moves which takes out liquidity and manipulates retail trader is called a turtle soup or liquidity rage, raid or a liquidity purge, right? Now turtle soup is basically a move which deliberately pushes price higher above all highs and all lows with the goal of simply taking out liquidity and purging liquidity and then filling up orders and then reversing and expanding in the counter direction quickly and explosively. That's what simply a turtle soup is, right? This is what we call a turtle soup. These are all the different definitions and introduction of turtle soup. You can remember whichever one you think suits you the best, right? So first one we've got is a bullish turtle soup. Now basically bullish turtle soup are false breakouts or purges below lows in a bullish market or bullish market structure, right? Bullish turtle soup occur when the drawn liquidity and bias is towards the higher or the upside, right? Pretty obvious. Now make sure to always integrate these with other concepts to achieve the maximum results when trading turtle soup or bullish turtle soup, right? And last but not least, combine it with CRT, just like we did in ranges and when trading ranges, right? Here is how a bullish turtle soup looks like. The drawn liquidity of the market structure is bullish and higher, so we are only going to trade turtle soup which are in the direction of the higher time frame drawn liquidity, and we'll be only trading those turtle soup which purges low and takes out liquidity below lows, right? So right here you're gonna match it with key dealing ranges and key levels because the most important turtle soup occurs at key levels and occurs at discount and premium key levels, right? So what happens is that price purged a low, take out liquidity, and then immediately it expands or reverses above, right? Here this is a bullish structure, and every time price expands above, it always makes sure to take out counter liquidity to with the purpose of rebalancing the whole range, right? Now again right here you're gonna find that more often than not, the low is always purged with a candle, right? And that candle could be potentially treated as a CRT on the lower time frame if it's formed at a key time and that CRT is purged at a key time. And these types of CRT are always high probability in terms of objectiveness and simplicity, right? Now next one we've got is a bearish turtle soup. And basically they are false breakout liquidity purges above highs in a bearish market structure or bearish environment or bearish market conditions. Bearish turtle soup occurs when drawn liquidity is simply lower. And again, just like with any other concept, make sure to trade it only when incorporated and integrated with other key concepts, right? Here's a graphical representation. Again, the same work, the same framework, but in the opposite direction, right? And right here, bearish turtle soup combined with bearish CRT, right? As simple as that. Now the last part of this chapter is finding high probability turtle soup, right? This is the most important part of this chapter because we'll discuss how to execute and find the highest probability turtle soup, right? And we're gonna do that by combining it with the other concepts that we've discussed so far. So the first point is that the best turtle soup occur at CRT, above CRT or below CRT, right? Such turtle soups are always high probability because they've occurred at time ranges, right? Which are more objective than the rest of the ranges, right? Second we've got is pretty cliche but really important. Turtle soup occurs at higher time frame key levels, including lower time frame key levels, right? You can use them both. I've shown you how to do it in my last trade breakdown. Now again, it is a bit cliche, but higher time frame key levels are really important, right, when trading these concepts. So must remember that higher time frame key levels are always important, and they are an inherent part of turtle soup and all the other concepts, right? So make sure to use higher time frame key levels in the direction of the higher time frame non liquidity to find the best turtle soups. Now, another important point is that high probability turtle soup occurs at previous weeks or previous days high and low, right? You could also use previous sessions highs and lows as well, right? But these are the dynamic swings points that are time derived, right? Now, another important point is that turtle soup occurs at the distribution phase of the markets, right? Now, we're going to discuss this one in detail in level 3 of CPI, right? What distribution phase is and how to actually integrate it and use it. But remember, the best turtle soup occurs at distribution phase and manipulation phase of the markets, right? At manipulation phase, we've got the most explosive and quick turtle soup, but at distribution phase of the markets, we've got the most smooth and transient turtle soup. So remember that. Now we're going to discuss this even more in level 3 and 4 of CPI, but here is a brief summary. I'm moving on to the next slide. Right here you can see we've got this CRT range on the higher time frame, and just above it we've got this higher time frame key level. So the best turtle soup will occur right above the CRT range have when it's purged at a key time and the higher time frame key level is tested, right? And then the target would be 50% of the range and then eventually the opposite end of the range. Right here, another high probability framework is when previous day, week, or session high or low are purged at key times along with testing higher time frame key levels. Let's look at some examples right here. First example we've got is right here. You can see this CRT. We've purged the CRT at a key time, and then you can see we've got this. We've had this turtle soup. It was high probability turtle soup, and then price expanded above explosively. Another example is right here. We've got this turtle soup again, and you can see we've got the same framework. We've tested a higher time frame key level. We've purged the high at a key time, and then we've had this high probability turtle soup which work out perfectly.